Welcome back to Higher Exchanges. I'm your host, Jesse Redmond, Head of Investor Relations and Business Development at Leaf Brands. I'm joined this week and every week by Morgan Paxia. He is the co-founder of Poseidon. Morgan, good morning on a rare morning episode for us. How are you?
I'm doing well. Yeah, here we do. A little something different this week. Checking out the morning time.
I know. I had to make sure I had my coffee. I got all cleaned up. Do you have any rituals, Morgan, that you do before the show? Like I always make sure I'm properly caffeinated. I always make sure I comb my hair and brush my teeth. Anything on your side you keep an eye out for?
I have make sure I have my water,
Yeah.
and a lot of my pre-show stuff is really trying to get the grok mentality going, so
Mm,
I can have a good surprise for the folks.
yeah. Well, we're also joined by Sam Brill. Sam is the CEO of Ascend. Sam, I think second time on the show. Does that sound right to you?
Yep, you got me right after I joined the first time.
You were fresh. Good. How have things been going for you?
It's been good. I mean, a lot of promising progress at the company. Appreciating the challenges that exist in our industry a little more as you get much deeper and into the lower levels of the company. But that's what makes us go, and so understanding how to navigate that and win is extremely important. But I'm excited. Our direction is good.
Yeah, we were lamenting about some of those challenges before we joined the show when we were in the backstage area. And yeah, people don't realize some of the things that should be simple. Just everything seems like it's harder when you're in the cannabis community.
Absolutely.
And Sam, when you were on last time, you shared a bit about your background, but we tend to have short memories, especially those of us that use THC products on a regular basis, might even have shorter memories. So, do you mind giving us a quick overview of your background and what you're up to before you got to Ascend?
Sure. I was running a private equity fund for about 6 years prior to joining Ascend. I was one of the early investors in Ascend. I think it was the second significant loan that the company had taken out to help grow the Illinois business. I was repaid early after the company went public, and became a very happy shareholder. And then a couple of years later was asked to join the board, which I accepted happily, and got to see how the company went from 12 million revenue when I first had the conversation to over $500 million, 562 to be exact for 2024. And it's been a very amazing ride. If you would have told me back then that we would get to the size that we are today, I would have thought the valuation would be a lot different,
Hmm.
given the growth and the speed in which it was achieved. But we're in a tough industry that's pretty much been abandoned by most investors. And we have 2,300 employees and a really solid business, and we got to put our head down and work.
And Sam, before you joined Ascend, you had a really great career. What would you say you were best at? Like, honestly, that's taken me a long time to figure out in my life. I'm 50. I've been working in the investment or cannabis industry since I was in my early 20s. So let's call that 25 years or so. It's taken me, honestly, a while to figure out what I'm really good at. Before you joined Ascend and you're thinking about becoming CEO of a company like this, what would you say your real strengths are?
It was really identifying opportunities within businesses. So it's you could look at a business and just kind of look at the P&L, the balance sheet, kind of understand the industry, but understanding where you can pull those levers to drive real value and improvement was what my edge was. On the private equity side, we would focus on, I don't want to call them dysfunctional businesses, but businesses that are not tended to the way that more professional business would be run. There are a lot of baby boomers that grew fantastic businesses over time, and as they get older, they don't have like the next generation that maybe is not interested in the business. Maybe they don't have kids, but they've done so well that they kind of, I guess they're semi-retired. They kind of lean back, and the business is not generally being run efficiently. or they haven't kept up with like technology and things like that. So those were a sweet spot for me, and just seeing that those types of opportunities and being able to implement strategies to just drive both growth and but more importantly those efficiencies and cash flow generation was key. So that's what I would say was probably my biggest strength, and taking those skills here, and we've had a full quarter behind us now, and I think it demonstrates that skill set pretty well. We substantially completed the $30 million in cost savings, annualized cost savings that we said we would put into place. It's a lot quicker than we had thought. We thought it would take 2 quarters to get that done. We did it in a quarter. So I'm very proud of the team for being able to move swiftly and implement that change. But there's a lot more work to do. We got it. Like, we're in a tough industry, and we're fighting every day for customers, and we have to stand out, and never sit back on our laurels. You got to adapt and attack every single day.
Yeah, so I would say, Sam, maybe you're good at showing up for the really hard part. And I think the hard part to me isn't figuring out where to cut costs. Like, we can all look at a spreadsheet and put some zeros in it or delete some rows or columns, and all of a sudden we can drop the expenses. But how do you think about doing that, Sam, in the context that you don't want to compromise the quality of the product, or you don't want to compromise the customer experience? So when I think about cannabis, you have the cultivation side. If you skimp too much over there, the product quality suffers. You have the retail side, another big part of your business. If you skimp too much there, you cut too many employees, you cut store hours, you generally try to get more efficient. Sometimes that creates a worse customer experience. So how have you found the way to thread that needle where you're cutting costs while also not compromising the quality of the business?
I think in this particular case, it's a little on those ends. There was a lot. It's more about changing how you do things rather than really cutting deep. The biggest cuts and the biggest savings. So just to split it up, half of it was on SG&A, and the other half is in cost of goods. So the cost of goods, you're really not going to see that benefit for another quarter or so, because we have to cycle out of all the products that we had previously made. And then you'll start to see that in the benefit of the new products. And even the new products, not every single change is fully in the costing for Q4, and even most of Q1. Like, a lot of the automation initiatives and things like that have not been fully implemented, and so that you're probably not even going to see until Q3. But those actions were taken, and so that it's happening. But the biggest cost savings was really on the corporate side. We were just built more like a Fortune 500 company, which I think works in a different industry. So it's not to say that we just created a bad structure. I just don't think that was the right structure for this company at this time. Or maybe at this time, I'm not sure any time, because we're just in a business where we don't make widgets, we grow plants. They're live plants, and plants are extremely sensitive to every tiny change in environment. And if you're not on top of that, literally by the hour, you can have catastrophic events that really impact the outcome of each harvest. And so the layers of middle management that prevent things from escalating to where you can take proper action quickly is key. You can't have that layer in between the decision makers, and you have to be able to react quickly. And in our business, you can't have that layer. It's good to have people strategize and think and whatever, but we could all do that too, but it's helpful, but it's not in this business. In this business, it actually creates a separation that has significant negative. So it actually, in my view, you end up losing more than you gain by having it. So it was really getting out that middle layer and just solidifying a very down up, where we can get the information to flow up more easily, so we can be on top of every single situation and act swiftly, make changes as quickly as possible. So for us, it was just a lot different. The corporate structure had to change, the org chart had to change, and the mindset had to change, because we were very focused, also on more revenue growth than free cash flow. And in some cases that led to producing products that didn't necessarily have margins that made sense, entering into relationships that weren't mutually beneficial. But all these things grew top line with very little benefit to free cash flow. And so it was also just changing that mindset and realigning the entire company to be focused on free cash flow. But also, like, the way we're going to win is by putting the customer first in all our decision making, which also sometimes gets lost in the day-to-day of just running a big company. So it was also so on the cost saving side, yes. So taking out that middle layer, that was a substantial portion of the SG&A savings. The other SG&A savings were just we used a lot of third-party contractors for things that, frankly, we had the internal resources to do. But I think when you have middle managers, they tend to just lean on others and not take responsibilities on their own. Not in every case, but in our cases, that seemed to be what the driver. So just getting out of those things, but also I think just lining up, like on the retail side, lining up the retail hours of employees with transactions. So it's nice to have a lot of employees on the floor to service the customer because, like I said, everything is customer first, customer centric. But if you don't have the right amount of employees on the floor when at the busiest times, the customer is going to feel like they had a poor experience. So we just it's not rocket science, but it's to me it was pretty basic for retail. Is every single, like, all the hours get lined up with transactions. We know our transaction history. We know when the customer's in the store, and you have to have enough employees to service those customers where they feel like they're getting that attention. The lines are always moving, and they're not waiting too long to check out. So that was a pretty significant actual cost savings because you don't have like 10 employees sitting on the floor when there's two customers. So matching that up made a lot of sense, and it actually saved us thousands and thousands of hours of that were just wasted of people just doing not much. Not their fault. It was just the way the structure was, and we had to put the right one in place. So, but like I said, you can put in all the cost cuts, and like to your point, if you're not servicing the customer and you're not making the customer happy and you're not doing everything that you can to have the right products and the right environment, you're going to lose the customer. So we installed this culture of customer first. Every single thing, every decision, every strategy, every product, it all starts with one question: how does it serve the customer?
Yep.
That's all it's about. And so it's like we have to change that mindset. It's so important that, like, when they go visit our retail locations, right? It's not just a building, right? It's where the customer connects with our brands, right? So it means like that great service, the friendly faces, the shelves are always stocked, every single time they walk in. And if we don't make that part of our ethos of what we're doing when we're creating products, right? When we're on the CPG side, we have a lot of brands. And it's like thinking about those brands like a real CPG company where we're constantly innovating and meeting the customer where they want to be met. And I think that, like, at the end of the day, if we're going to win, like, that's like putting the customer first it's not like the slogan, right? It becomes your edge. And we have to make it our edge or we're going to fall behind. So we've taken that to every single level, from retail to the production side and the cultivation side, to make sure that we're really focused on that customer experience. And we're making a lot of changes. I mean, we're changing 350 SKUs because the packaging didn't reflect the product that was in it. We moved we came so far so fast. As like that hyper growth that we went through, where it was like, you just make weed and you can sell every single like ounce that you produce, right? It's not hard at the beginning. But now we're in like these competitive markets. There's lots of competition. People have choices. And we tended to just put them in bags that didn't stand out. And frankly, as we got much better at producing products, our products became a lot better than the packages we were putting them in. And at the end of the day, with retail especially, consumers, their first impression of a product is the packaging. And that is going to affect your perception, whether, no matter how great the quality is or how crappy the quality is, it will either elevate the perception or hurt the perception depending on what it looks like. And we unfortunately had a lot of packaging that really did not do justice to what we were putting in those packages. Because when you look at our products and you try our products, you will find, like in a blind test, that we stack up to anybody. Yet when you look at our packaging versus competitors, it was very disappointing, actually. But on the flip side, it's a great opportunity to finally have packaging that matches what we've been making. And it's a testament to the people in our facilities who have taken up that level, brought our level back up to where we're really competitive with everybody, and we can go one-on-one with any product. But again, just they never got the credit for it because we're actually demeaning in a way their product, the things that they're making, by putting it in packaging that doesn't match. So it's not, again, it's a simple thing, but it matters. And it's part of the step of like making sure the customer really understands and appreciates what we're delivering.
Yeah, I think that's a great point, especially, I think back to the Prop 215 medical days in California. And back then it was deli style, where you'd say, "Oh, can I see that SFEOG?" And they'd hand you a big jar and you'd snip it and you'd really make the decision based on what was in the jar, in the bag. Whereas in this modern era where you order on iPads and you just have bags sitting on shelves, people do derive so much of the perception from what the package looks like because they can't actually get inside of the bag at that point in most cases.
Yeah, agreed. And with non-flower products, especially, like that's even harder because there's nothing to smell or, I mean, with the edibles, you get to taste them, but only when you get home. So, it matters. And that CPG mindset, will drive results ultimately.
Well, Morgan, I know you've been a long time investor in Ascend, and Sam, it looks like some of these changes that you've been making already flowed through to the most recent quarter, and you guys are making some good progress. So why don't I pass the mic over to you, Morgan? You can walk us through the most recent quarter.
Sure. Well, yeah, I just thought that was a really interesting conversation around brand. I mean, we talk about it quite a bit. As brand is basically a contract with your consumer, right? And Jesse and I have talked about this quite a bit. Unfortunately, we've seen a lot of California brands, to your point, start cutting on costs and suffering on quality. And when you go to the store and buy what used to be a good brand, and it's no longer the quality it once was, like that contract is broken. And for me, I've definitely lost confidence in a lot of brands out here, unfortunately, as a result, because just the consistency, the quality is just no longer there, and that's a big deal. You lose that customer, and then you try to earn it back. It's really hard. But therein lies some opportunity as well, as you were mentioning, Sam. But I was just thinking too about when we first started with Ascend in the early days. Abner used to call it the MSO 2.0, deep, not wide, and really trying to focus on key markets, trying to really focus on having strong retail location. And that seems like you've taken that initial strategy, but it's evolved quite a bit to now being much more, having those elements, but being much more consumer focused. That seemed to resonate very strongly on the earnings call. For folks that haven't listened, I would definitely recommend going back to on Quarter or however you like to listen to it. It was a great way to hear Sam talking through that. But Sam, how do you think, is that a fair summation of Ascend's journey to this point?
Yeah, I think so. And I think, look, the great thing is that we have these core assets in place already to build on. So you can't necessarily get those locations. Locations are very tough. And a lot of people just raced to get stores open, which was extremely valuable in the early AU days, because it didn't matter where your location was, frankly, on day one. You didn't have a lot of competition. I mean, New Jersey only had like 20 stores the first day. So wherever your store was, people were going to find it and shop with you. And the numbers were going to be big. So like getting open quick was important and probably trumped location in most cases. We stuck to that discipline of finding these great locations on Main and Main and high density, high trafficked areas, like retail areas, not just areas, but retail is the key. You want to be part of the consumer's routine, whether it's going from work to home or when they shop. You need to be located in a place where they're most likely to find you. So you're convenient, you're on the way, you're part of the retail experience. You're on the list of to-dos when you're located conveniently within an area like that. And we have a lot of great locations like that. And the other piece, of course, is parking. You've got to have good parking, because otherwise, people that's a big friction point in a lot of places, especially the more high traffic stores. And so we've done a good job. Not all our stores, unfortunately, we didn't get every single store in a perfect location, but I would say maybe 2/3 of our stores are in these premier locations where that ends up becoming your moat in the more competitive environment, because it's hard enough to get the customer as more competition opens. So you better be in that right thoroughfare where it's convenient and you're making that part a lot easier. And then when you get them in, you better do a phenomenal job of giving that great experience and making sure that they want to come back again.
Yeah.
So you got to have all the key, like that. You have to have all the staple products, right? So you better know the staple products in each region. They're very different region by region. You can't have some homogeneous menu across the country. It doesn't work. So you got to have all those right products for that right region. And obviously we have to have, the right customer service and focus on creating an experience that makes it super simple. And that's another piece that we announced on the call, which was improving that online menu and in-store kiosk to make it easier for the customer to find what they want. And we're very excited about these new software tools. We just launched it in one of our stores to test it out, and then hopefully this test goes well and we can spread it across our entire 40 store network. But it just allows the customer to more easily find what they want. It will know who you are if you're a loyalty member, and it will be able to use AI to make suggestions for what you may want to purchase based on your previous purchases. But more importantly, if you're looking for something new and you put something in the cart that's new, it's going to know what everyone else who bought that product liked as well, and it can suggest those things too to make it. And again, I know it sounds so like everyone does this, like in regular retail, but in cannabis, this is still new. And we're very excited to be able to use that and give that to our consumers so they could really feel like when they came into our store, they found everything that they wanted.
Right. Yeah. So you were also mentioning, a bit ago about, obviously the cost savings initiative went faster than expected. So that was a great feature in the fourth quarter. But you also talked quite a bit about your inventory levels and getting that, very focused and right-sized. And so it seems like that's a bit of this discussion around, regions. We're even, long time in the space with, even municipalities or townships, can have varying consumer behaviors. But can you explain a bit more about some of the inventory work you were trying to accomplish in fourth quarter and how that's going into 25?
Yeah, I mean, I think we got our balance sheet at the end of the year to be in a place where that's where it should sit pretty consistently within a band. And it really was driven by the fact that there's another thing that I think is often forgot about cannabis. Our products expire. We have perishable products. And it's just an often time overlooked fact that we're not selling a product that can sit on the shelf for a year or 6 months even. It's not as bad as produce, but it's still perishable, and as time goes on, it does lose, especially flower itself. It loses parts of it, right? It's the trichomes start to burn off, the terpenes start to burn off after a certain period, and so yes, you'll get high, but you're not having the same experience as if you bought it when it was fresh. So it's extremely important to differentiate between the two. And we're still trying to figure it out. But a lot of the things that are discounted, the consumer does not realize that the reason it's discounted is because it's aged. And so they'll look at the testing at like a fresh product versus an aged product and be like, oh, that aged product is like tested better and it's cheaper, so I'm going to get the aged product. But the reality is the experience that they're going to end up getting is probably going to be disappointing. And that's not good for the brand that that jar was in. And it's not good for us either, right? We want customers to have that robust, like real full experience that was intended when we grew the plant originally. So it's like getting to a proper inventory level keeps things, you have fewer of those, like, you know, blowout discounts where you're just trying to get rid of aged product, and you don't have the aged product necessarily competing with the new product, which is also an issue and creates this like bad cycle. But I think from a customer experience perspective, they're going to hopefully buy more products that are like fresher, and they get that full spectrum experience that was originally intended. And so that's part of like what we're trying to achieve. But at the same time, you have to have inventory levels that reflect a certain amount of days of sales outstanding, so you're not getting to a point where you're constantly discounting or constantly selling a higher percentage of aged product that, by the way, again, the customer is going to be impacted by that. They may think they got a good deal, but ultimately they might not, right? You got 30% off, but you're like, man, that tested well, but that weed sucked. And that's not like, you don't want to leave them with that flavor in their mouth, because maybe they don't come back to you because of that, or maybe that hurts that brand because of that. And that was not the intent, and that's not what we're trying to achieve. So it's really like, it's multi-level there, but we had to get to an inventory level where we're staying roughly at, 30 days or less in terms of days of sales outstanding, and managing that better. So that means smaller monthly orders. Maybe you do it, by month, like every 2 weeks or something like that, assuming that the vendor can meet those requirements. I think more and more are. I know that we are on the Ascend side, because we understand how people are sensitive to that. So we're going to be sensitive on the other side. But this way you don't get long products too easy. You have to, you're buying 2 weeks worth of the product. So if it stretches, you're not really left with a lot on the shelf. But we're very tight on managing the inventory in the store.
And that's two functions, right? Because you have a good share of shelf with products that are Ascend products in Ascend stores, but you also do buy third-party products for your stores. So managing both sides of that for production purposes, but also for sourcing and managing that inventory as well. And when you think of, I'm a big fan of, copy what works, and always trying to look at, other sectors and how those things are comparable. And you mentioned grocery is not a good fit because, it's not quite as perishable as a banana, for example. But have you thought about that? Have you looked at other sectors and trying to look at their inventory levels and how that translates, or is it really more a function of your sell-through rates and turnover and managing from that perspective?
Yeah, I mean, I would say that was the spark, right? Was to think about those industries and kind of rethink the way we had done things. But then take like real world examples within cannabis of like, how is each product affected by age? So like, where do we have to be more sensitive? And flower obviously is the place where you want it, especially the high-end flower. You need to be super sensitive, because that high-end flower is not really necessarily high-end anymore after a certain period of time, right? Because it's degrading, and no matter what packaging you use, the bags are better, by the way. So we're getting rid of jars. Just they don't look as good necessarily as a jar, because a jar and people could do funky things with jars and make them look really cool. But the reality is, unless you have like a very special top, it's not sealing it properly, and it's actually degrading the flower quicker the second you open that jar. And so with bags, at least with the resealing, it has a longer shelf life, not for us, it's for when the customer brings it home.
And why is that, Sam? Can I just stop you there on a nerdy level? I always thought the jars would be better, but you're saying the Mylars preserve better than the jars?
Yes, the jars, unless you have I forgot the name of the seal. There's some that you buy these expensive jars that have a special seal that reseal it properly, but a regular jar, the average jar in the industry, does not seal it properly. There's air getting in, and it's killing all the trichomes. And
So this is a jar from 710 Labs, which is
okay,
a fancy California brand, and it has this metal thing that you put on here, and then you screw it like that. So maybe that's
so
that.
that might be a version where it keeps it fresh. This is very expensive packaging, and
Yep.
not all
Yep.
customers will pay for the premium for that. But that's an example of something that probably works. Whereas the average jar for the industry, like it's got usually like a little either piece of plastic or piece of like styrofoam or something like whatever, some padded something, or tins or whatever. But those generally, the second you break that seal, you're starting the process, and covering it's not really preserving the flower. So the Mylar bags are much better at that. It might not be as good as that jar, by the way. The jar might be better than the Mylar, but again, it's definitely significant. We think it's a significant improvement on the packaging side for the freshness for the consumer, so it will last longer, and they'll be able to maintain that same experience that was intended for a longer period of time, because not everybody's going to smoke an eighth in a weekend, right? So if it's over a month and you're leaving it in a regular jar, it's degrading already. And so whereas in the bag, it's probably holding its freshness better. So
do you actually educate the consumer about that? Like, do you have anything on the bag that says like consume within X amount of time after opening, like other perishable foods would say, like, you got 2 weeks or something? Or
we haven't gone that far yet. I mean, we do
Yeah.
have something that says like to preserve freshness. There's like something preserve freshness, like, but it's like a few words. It's not saying that, consume within X period of time. Although there's an expiration date on every single, it's required by the state in most states, not every
Right.
state, but most states it's required that you have an expiration date on it. I don't know how many people pay attention to it or believe that it's legitimate. And because you might not tell the difference if you're close to the expiration date and you bought it at a huge discount, it might not smoke differently when you buy it versus you're past the expiration, because you've pretty much gotten there already, and what's in that bag or jar is no longer fresh anyway. So the difference in degradation might not be as severe as it is from the real freshness to call it aged. So, but yeah, the flower category is definitely more affected by that. The gummies have probably the longest shelf life. And then depending on the vapes, there's there are different varying dates where it starts to become problematic. I think the live rosin has the shortest shelf life of that category. So, but we're very we're cognizant of every single category and making sure that the inventory levels match those shelf lives, so we don't end up having to blow out this discounted like aged product, because it does compete against the existing. And like you were talking about on the wholesale side and how we're looking at it from the wholesale. I mean, on the wholesale side, we understand how these things sit on other people's shelves, and so I said this on the quarter, but we made a conscious decision not to stuff the channel at the end of Q4, and we're not going to do it again. We're just not doing this. It's not a good practice to do this. So we're not chasing, quarter end or year end sales in order to hit some number on the street at revenue. First of all, it's not going to be high margin because we're going to have to discount it anyway to hit those numbers. But number two, what you end up doing is you stuff the channel. And that means that all your customers are going to end up getting long your products. They're going to end up having to discount it, and by the way, undercut your fresh products. And you're not going to be able to sell your fresh products into them because they have too much of your inventory. And so it just creates a whole plethora of additional challenges that we prefer to keep the channel clean, keep it fresh, and keep it normalized, so we can ultimately serve the customer, because I don't want to sell them aged stuff. It undermines my brand, it undermines the value of my product, and it's not giving them the experience that was intended. So it goes back to that original statement. How does it serve the customer?
As you're looking at 25, one of the things you noted on the call was 50% growth, right, in retail this year is the target with your partner stores.
it's not this year, it's in the medium term.
Medium
So
term. Okay.
yeah, so it's at some point in 26, we will have gone from 40 to 60.
Yep.
And we have 10 in the pipeline right now that we expect to close before year end. And so we're excited because there's a lot of, it's great to have a strong balance sheet. We closed the year with over $88 million in cash. It's become a buyer's market. Not many people are paying cash for things anymore. Most sellers don't want to take equity. They've been burned time and again. And frankly, we wouldn't give up equity at this value anyway.
Sure.
So but it's become a buyer's market. We have just in the time that I've been with the company, and I've only been with the company for like 6 months or so, the pipeline that was there my first month versus the pipeline today is just night and day. There's so many more choices, and the valuations of all continue to decline as some of the realities in the public markets set into the private markets. And I think that's positioned us in a great place to add the density in the areas that, that make sense for us. So of course, the core markets are number one. We have these big fixed cost assets. We want to have more retail in those states, so like Illinois and New Jersey in particular. And so we want to get more partners in Illinois. We want to get more partners in New Jersey. So we think we can get up to 20 in Illinois. We think we can get up to 10 in New Jersey. And that's going to help more the verticality in those states. And of course, those states we know the best. We're in 90% of doors in those states. And so we know what every customer is buying. We know the velocity of sales. We understand the dynamics of each market and each sub-market to make much better informed decisions and choose the winners as we see them. And then as we discussed on the store, on the footprint part, where we're very, very, very focused on location, that's becoming just as important. We're not going to, even though like a store is doing like, let's say, a big number and it looks like, oh, this thing is great. We look at the location and we're like, okay, it's great because maybe not a lot of competition, showed up. It's on a border. And we're thinking to ourselves, when competition shows up or the neighboring state flips to AU, and this store is going to be at risk. And so are we really paying as cheap a valuation as we think long term? So we want to really focus on those, key locations that are core to our original business model, be on those main locations where we feel like we have a moat, and that is going to be a long-term winner that's going to compete against everybody. So we're trying to find more and more of those, and thankfully, as the pipeline fills up, we're getting our choice, so to speak. So we're excited because we've locked up 10 opportunities, and we don't control the timing of those store openings, or in some cases they're openings, in some cases it's like when the regulatory bodies approve the transfer. So that's why it's, we're not trying to be evasive. It's just that we actually just don't control the timing. So we have a ballpark of when we think that they're going to close, and we feel good about that we feel good about the idea that we can get those 10 done by the end of the year.
Yeah.
And hopefully the other 10, we want to move faster if we can, but it's, we don't fully control that timing or the regulatory piece. In some cases with getting stores open, it's like getting the CO and dealing with local municipalities. Each one is very different and can have its challenges. So, but our team has their head down and they're working as hard as they can, and they're incentivized to try to beat the timelines that we have. So that's just the first step is the 20. We feel like that's, that's very achievable, but we're always looking at additional opportunities and additional markets as they arise at the right price. It has to be at the right price. There's some markets that still are overpriced because of the hope of what might be on an AU flip, or it's still early enough where they're not seeing the competition and the declines yet. But we know that game. We know how it's going. We know how it plays out, and so we're trying to stay disciplined. Every single dollar in cannabis, is cash is king in this industry, and we know how precious it is, and we're very focused on that for our shareholders.
Yeah. Yeah, no, I'm a big fan of verticality. I mean, I think it's such a powerful way of controlling your destiny, especially in an environment where you have so many of your competition that might be getting weak and desperate. And to your point about stuffing channels, I think that's a really interesting point that I think is more of a newer phase that these limited markets did not have for a long time. And so, being able to have more control over that so that your consumer is not, being impacted negatively because of that experience, I think it makes a lot of sense to have more control over that. And so I think that's just, I think it's a smart strategy. But I just, we've been hearing, oh, this X company just dumped a ton of product. But I really hadn't, put the whole piece together. And so it makes a lot of sense. But as you look at 25, and I totally understand about the timing of these things is incredibly challenging. Business versus government are two different speeds. How many times have there been a meeting with a government where, to get a transfer of a license or an approval of something, it's a Zoom meeting and, oh, there's a winter storm and we're going to cancel the meeting this week and reschedule it, all that kind of bullshit where it's like, but you're all on Zooms at home. You could still have the meeting, but they just like look for excuses to not do things or just take more time to do things. And to your point, it's outside of your control. So you just try to manage the pipeline as richly as you can so that they do kind of start to play through over time and it just keeps, turning on. I think that's really hard for most individuals to truly understand unless you're like in the weeds and seeing that, firsthand and just how frustrating that experience can be. But that is the reality is like and I know everybody's trying to get things done, but there are just things that are outside your control. And so you just, try to keep focusing on the controllables. I did think it was interesting though, just starting to read some of the analyst reports. I was a little surprised to see that, they were actually forecasting for a little bit of a send decline year over year top line. Do you think that was a bit of them trying to reflect on baking in that regulatory friction that would prevent some of the growth, or how do you look at growth in 25 over 24?
Yeah, it's challenging, obviously. The biggest issue that we see is just the price per gram declines in some of the, in the better markets, right? In the markets where you've already had it and, you're kind of, it's less marginal. So like, Michigan, the price per gram, I think is the lowest in the entire country. So it's kind of like, can it go lower? I mean, I guess I would never bet against it because whatever can happen in cannabis happens. There seems to happen, certainly on the bad side. So, that's definitely something that we're watching because there are markets that are, on a price per gram basis, still on the higher end. And even though our transactions might go up or at least the grams that we're selling has consistently gone up and to the right. The challenge is the price per gram comes down at a faster rate than your increase in, grams that you're selling.
Units.
So I think that's something that's like industry wide. If I look at everyone's numbers, all my peers, I'm not sure that there are many that have year over year growth that's more than single digits, and most of it's not being driven by organic growth. Right. And my growth is, look, we're taking actions to solidify the moat that we have, but we still have that reality of price per gram and trying to handicap that as best we can within the numbers, and then look at what the actions, like we'll see the results of these actions and we'll see how long it takes to really trickle through to the consumer and, building better loyalty and consistency within retail. But ultimately, I think the biggest sort of moving part in that growth are the additional stores, and it's a lot of them, and it's a lot of growth actually. But I couldn't handicap perfectly what that would look like, and I think some of them are just being conservative about that timeline and trying to do their best on their end. So we'll see. It certainly gives me a target that we want to not just meet but exceed materially. That's
so maybe a little U-Pod, if you will.
Yeah, look, it's something for the team to hopefully have a little chip on their shoulder that this is where we're being handicapped, and we got to execute, because we got to beat that and get those stores open where we can, where we control anything.
Yeah. All right. Last question for me, and I'll pass it back to Jesse. But any investments you'd like to highlight? I know at the beginning of the year you guys did a quick little accelerated buyback with, it doesn't take a lot of cash, to your point, at your market cap to be a meaningful difference in reducing shares outstanding. But anything you want to note from an investment perspective?
Yeah, I mean, look, we're very excited. We're not excited that we could buy back our shares so cheaply, because it's just a frustrating place to be. But at the same time, when I think about your return on capital, buying my shares back when my market cap is like, I don't know what it is today, but last I checked, it was like $65 million market cap. I closed the year with 88 million in cash. We are generating cash. So if I could buy back my cash at a discount, I'm going to do that all day long, as much as I'm allowed. So I think it makes tremendous sense and it's a form of returning, the value to shareholders. And I think that that's one of the best ways I could do it, in a very simple, easy way. So it makes too much sense. And from we view our shares as undervalued. So we're going to lean into that as much as we're allowed under our loan agreement.
Not that this is investment advice, but I did put it into Grok, all the various MSOs after the Q, and Grok said that Ascend was a screaming buy.
So I'm flattered. Got to use Grok more.
Exactly. Give you the answers that you want. And Sam, I know we need to get you out of here in about 10 minutes or so. So maybe I can just leave you with a couple of final questions. Can you talk about what you're most excited about for the rest of 2025? And on the flip side, what keeps you up at night being Ascend CEO?
I'm just most excited about we planted a lot of, trees, so to speak, when I first came in. And so, we got the cost cuts, that part, it's like scoring a touchdown in the, first 5 minutes of a game. I'm not going to celebrate. It's good. Like, you want to get that, get on the scoreboard, but it's not a win. So it's really about all the other actions we took, and just seeing the fruit of all of that hard work come to fruition, I think is what I'm most excited about. To see this team really come together and deliver under this new but important goal for the company, this customer first approach in everything that we do, combined with all the operating efficiencies and all the things and actions we've taken, rethinking the way we do everything based on that. So you don't just, production plan based on, your feel. We're doing it based on real data. We're doing it based on, all the information we've put together. So I'm just excited to see it all come together. So that's probably what I'm most excited about, is just seeing how all the things that we've put into place, how does that come together? How do we execute going forward? How does that culture start to dig in deeper and really drive long-term results? So, and then what keeps me up at night? It's just the challenges of cannabis, which are mostly driven by, the regulatory, overhang of being illegal on a federal basis. And then the constantly changing landscape, I think, on a state-by-state basis, on the regulatory side. They're always tweaking things that don't need to be tweaked, it seems. And it's frustrating, because we're already fighting with hands tied behind our back. Yep. It's we don't need additional challenges. So I think that keeps me up at night, just the prospect of what that next thing might be. So, I would love to have some tailwinds there rather than the constant headwinds that we've always faced. But that can't be a strategy. We have to operate and adjust to whatever environment we're in, and we're certainly not sitting on our laurels, like thinking that, oh, this is going to change, this regulatory thing's going to change. We're assuming that nothing happens, because we haven't been that lucky in this industry, and luck's not a strategy.
Yeah, that reminds me of some conversations I had with Charlie at Cresco a year or two ago, and I think it was when I was interviewing him on stage at Benzinga. He said every year is now year of the core. It's just who we are, and it sounds like that's a mindset you embody as well.
100%.
Yeah. Well, this has been great. If you have another 5 minutes or so, Sam, Morgan's going to hit us with a quick Ask Grok. We'd like to talk about AI things, how we use them in our lives. And you probably know Grok is the AI tool on X. They have a new one called Grok 3 that we've been enjoying. So why don't I kick it over to you, Morgan, and we'll close it out with your Ask Grok.
Cool. All right. Well, Sam, I think you'll enjoy this after today's conversation. My question to Grok, I said, Charlie Munger is well known for saying invert, always invert. How is this applicable to the cannabis investors today? Charlie Munger's principle of invert, always invert, encourages tackling problems by considering the opposite of what you want to achieve, essentially identifying what could go wrong and working backwards to avoid it. Today, this highlights risks like regulatory setbacks, market oversupply, cash-burning companies, shifting consumer trends, and economic shocks. Investors can succeed by avoiding these traps, favoring firms with strong fundamentals, diversification, and resilience over hype-driven gambles. Munger's inversion doesn't predict the future, it forces clarity on what could derail you. Cannabis investors who map out failure scenarios, then invest to avoid them, stand a better shot at weathering the chaos.
Was that inspired by Ben Kovler's tweet this morning, Morgan, that said invert, always invert?
It was funny that he said that today. That was just purely a coincidence. I was actually, that's been in my mind this week. I was messaging others in other matters talking about invert, always invert. So I just thought it was funny that Ben put that up there, but it was actually from another email I was reading. There was a whole nice rundown. Anyway, so just coincidental.
Something about great minds thinking alike.
Oh, the Berkshire meeting's coming up. So
there you go. Sam, when you were on the investment side, were you more of a growth guy or value guy? Did you have any particular style that you tend to lean into?
I was more on the value side, I would say, like value special situations. So kind of, I liked messy situations that people would just tend to not want to roll up their sleeves and get involved with, and kind of make sense of that chaos. And oftentimes that was a great place to be, to really have outsized returns on a risk-adjusted basis, especially.
And Abner's a value guy too. Abner was from Baupost, and isn't Baupost a value group as well?
Yeah, I mean, I'm not as, I mean, we all know the big name, but I'm not as familiar with what and I think they've grown so much. I know, like, I forget what their original core was. I think maybe their core was that, but they're so big that I think they do a lot more than just where they started as the fund grew. So, but yeah.
Well, awesome, Sam. We really appreciate you joining us. Anything we didn't talk about today you want to touch on in the last minute or two?
I think you guys really did a great job of covering like everything, like most of the things that are going on. Obviously, as you get layers deep, it just gets, the challenges that in the day-to-day are there. But, like I said, I think we put together that core that really understands the goal, and we're all rowing in the same direction and driving the business and understanding the challenges. We can't sit here and cry about, the disadvantages we have. We have to work with those and adapt to every single change and win. And I think that's the way you're going to win, is with the customer. And that's the focus.
Yeah, I love the conversation about the branding stuff, and I also like that you're concerned about things like freshness of the product, because I feel like that's sometimes just something that's lost. I feel like in the old days, the MSOs just figure we'll put some weed in a bag or a jar, people will buy it, and it's going to be easy. And it's nice to see that you're focusing on some of those nuances and doing these cost cuts, but doing so keeping in mind that you want to keep that customer experience and you want to keep the quality of the product's really high. So definitely enjoyed the conversation, Sam. Congratulations on the progress that you're making, and look forward to having you back in a quarter or so.
Absolutely. Thank you guys for having me. Appreciate it. This is fun.
You're welcome. Morgan, always good to talk to you, my friend. Thank you all for listening. Thank you all for watching, and we'll see you next week. The views expressed in this podcast are provided for informational purposes only. Nothing we said should be considered research nor recommendation. All investing involves risk, including the loss of principal.